Something huge is brewing behind the scenes of Wall Street, and AMC is right at the center of it all. If you thought the short squeeze talk was over, you're about to realize just how wrong that assumption was. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But everyone, remember, this is not a financial advice video. Let's dive into a massive and increasingly volatile situation that's starting to reach a boiling point, UBS, and the toxic swaps tied to AMC and GME. These financial instruments have been quietly threatening the stability of major institutions, and the latest developments only confirm just how dangerous things have become. According to a revealing tweet from user @741trey, the drama begins with UBS inheriting a massive load of swaps from the now-defunct Credit Suisse. Remember, Credit Suisse and Archegos had previously loaded up on AMC and GME swaps, and those turned out to be catastrophically bad bets. So bad, in fact, that they contributed to Credit Suisse's downfall. When UBS took over Credit Suisse's assets, they also got stuck with these swaps, something they clearly didn't want. Fast forward to now, and what we're seeing is a standoff between UBS and regulators. The CFTC, the Commodity Futures Trading Commission, has decided it will not pursue enforcement actions against UBS for failing to meet margin and clearing requirements on these specific swaps. That's an enormous deal, because if UBS were forced to comply with these financial requirements, if they were margin called or required to clear the swaps, it could lead to UBS defaulting. But it wouldn't stop there. The collapse of UBS would send shockwaves through the global financial system, potentially triggering a catastrophic meltdown. Why? Because these swaps are not just big, they're massive and deeply interconnected. While they include various positions, AMC and GME are two of the core components. And this tells us something very important. The financial exposure tied to these stocks is still massive. People claiming that AMC has no short interest or that a squeeze is unlikely are clearly missing the bigger picture. This isn't just speculation. The refusal to enforce standard margin requirements and the ongoing delay in swap clearing speak volumes. It's clear the authorities are buying time, likely hoping for an escape hatch that may never come. If they had to pull the trigger and margin call these toxic contracts, the resulting fallout would be enormous. UBS would face a financial tsunami, and the domino effect could bring down other firms connected through counterparties and overlapping liabilities. In the meantime, AMC itself is pushing forward. The company recently completed major renovations in two of its flagship theaters in New York, Empire 25 and Lincoln Square 13, installing over 4,000 premium recliners and upgrading facilities. CEO Adam Aron noted a significant boost in guest satisfaction scores as a result. While this won't cause earnings to rocket overnight, it's a positive move. Increased comfort equals higher attendance. More attendance equals more ticket and concession sales. It's a long-term play, and AMC seems to be making all the right moves. Now, here's where things get even more interesting. Reverse repos. According to Zero Hedge, the Fed's reverse repo balance just plunged by $34 billion, hitting its lowest point since April 2021 and quickly approaching zero. This matters because reverse repos are a key liquidity tool for financial institutions. When that liquidity vanishes, so does the cushion shorts have been relying on. Remember what happened when AMC and GME squeezed before? The Fed had to inject over $2 trillion into the financial system to maintain stability. Now, we're seeing that safety net drying up. That puts shorts in a very dangerous position. As liquidity vanishes, these institutions will be forced to sell assets, starting with commercial real estate, which is already happening at massive losses. Properties that were purchased at peak values are now being sold for half their original price. These desperate moves show just how tight liquidity has become. When real estate isn't enough to cover their positions, the next layer of collateral, bonds and other financial instruments, will be sold off. And if that still isn't enough, That's when force buying begins. That's when AMC and GME become nuclear triggers. Wall Street is feeling the pressure. Short sellers are getting squeezed harder and harder, and they're running out of places to hide. To cover their obligations, they've started selling off other profitable positions, another signal that margin calls are already happening behind the scenes. Meanwhile, the brokerages are once again under scrutiny. Stephanie tweeted about more lawsuits targeting firms like TD Ameritrade and Schwab. These class action lawsuits accuse major brokers of operating against retail investors, favoring institutional players, and allowing manipulative practices. And it's not a one-off. We've seen this pattern repeat with Robinhood and others in the past. This isn't just about one company or one lawsuit. It's about an industry that has been structurally tilted against retail investors for far too long. And while you should always do your own research and make your own decisions, it's crucial to understand the broader context. The warning signs are everywhere. Let's talk about ETFs for a moment, specifically XRT. According to a tweet from Jamie, this ETF is currently being shorted at an astonishing 243%. That's not just excessive, it's insane. And guess what? One of its biggest holdings is GameStop. When you see an ETF being shorted like this, it's a clear signal that they're using it as a backdoor method to suppress the stock prices of the companies inside it, like AMC and GME. Why? Because they can't find real shares to short anymore, so they short the ETFs instead. It's another form of manipulation, and a desperate one at that. And desperation always leads to mistakes. The more they double down, the closer they get to collapse. It all ties back to one central truth. The shorts are trapped. They've painted themselves into a corner with toxic swaps, dried up liquidity, manipulated ETFs, and vanishing collateral. And the pressure is increasing with every passing day. Let's not forget the data gaps either. GME's FTD failure to deliver numbers are mysteriously incomplete. According to a tweet from What Can I Make Today, more GME FTD data is now missing than actually reported. That's alarming. It means they're not just trying to hide their positions, they're failing to follow basic reporting standards. When they suppress data like this, it's not by accident, it's panic. We've also heard from Wiz, who points out that if your short volume ratio reaches 848%, you're no longer managing risk, you're just asking to be margin called. This isn't normal behavior, it's reckless, and it reveals just how deep the manipulation runs. AMC and GME aren't just stocks anymore, they're signals. They're the canaries in the coal mine of a financial system that has been stretched to its breaking point by over-leveraged bets and corrupt practices. And just to drive the point home, consider what's happening with Citadel's Ken Griffin. Reports are surfacing that he's been selling his properties at steep losses, one example being a $24 million loss on a real estate sale. That's not something someone like Griffin does, unless liquidity is running dry and pressure is mounting. These personal losses mirror what we're seeing across the broader market: fire sales, asset liquidations, missing data, lawsuits, and crumbling financial structures. All of this is pointing to one inevitable conclusion: something massive is about to break. The shorts are scared, and they should be. They're cornered, and their time is running out. As retail investors, all we need to do is understand the signs, stay informed, and hold strong. The pieces are moving quickly, and it won't take much for everything to snap into place. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.